Hi, I'm Peter Rose, founder of Longwood Currency Trading, and just had a few thoughts for you on this beautiful July day. Actually, it's been raining on and off here in New England. The thought for the day is save your opinions for movie reviews. In a short blog post that I did on my website, longwoodcurrencytrading.com, not long ago, I wrote a post that I titled 3 No Tears Forex Currency Trading Rules. And one of those rules, the first one actually, was save your opinions for movie reviews. And it was just a very short, I don't know, it was like a paragraph or something like that. The best rules tend to be the simplest. It's following the rule that becomes complicated, right? I mean, if you've done any trading at all, you're kind of going to know that for sure. But what do I mean by save your opinions for movie reviews? Well, look, nobody gives a shit about what you think the price should do. The market doesn't care. Your brother doesn't care. Your dog doesn't care. Bo, do you care? My dog is out here with me on the porch. He doesn't care. It does absolutely no good to form an opinion on what you think price is going to do. You can't have an opinion when you're getting ready for a trade setup. You can't have an opinion during the management of a trade, and you damn sure can't have an opinion when you're trying to make up your mind whether to pull a button to close a trade or not. You can have a probabilistic expectation that some event may occur, but that's different than an opinion. I mean, an opinion is, this price will turn around because, I don't know, pick some stupid reason. It's Tuesday with the smell of daisies in the air, and the Bank of England surely wouldn't raise interest rates again. I mean, come on, it just, that isn't going to get you anywhere. Primary, everybody will tell you this. Every talking head on the video and in the books, everybody will tell you this. You simply cannot trade Forex, particularly Forex, because of its leverage that creates the volatility for you, which is opportunity or it's disaster. It depends on whether you've got rules or not. That's what everybody says. You got to have rules. Well, you can get totally out of control with building rules. You can try to have a rule for every possible wiggle on the chart that you see. If you read some of Al Brooks' books, he's very analytically oriented and technical and academic, and he'll say, well, here's this chart formation that's forming, and you've got these 4 candles, and you did blah, 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 blah. However, if the 3rd candle does this, then you might want to change your opinion, and here's a rule if it does that, and here's a rule if it does this. That's life experience from a bazillion hours of trading and looking at charts and seeing these different things happen. But basically, what you're doing in your mind is you're developing in real time, not after the fact, in real time, your probabilistic expectation that something's going to happen. Now, that something is either going to be good for you or it's going to be bad for you. The weighting of the probability, or the better you're able to calculate that probability or estimate it or whatever you're going to do, it determines how good it would be for you or how bad it could get for you. Trading isn't really binary as far as the magnitude of the price move is going to go. It isn't as simple as, well, it's going to go up or it's going to go down. There's a probability based on economic conditions, based on the time of day, based on the currency pair, on the momentum, the velocity, or whatever you want to call it, that the current currency pair is undergoing, what the ATR is. You're mixing all this stuff in together in order to make a decision as to what you want to do. But your opinions don't play any role in that. Save those for movie reviews to your friends. And yet, the I guess the opposite, save your opinion on the one side and have rules on the other side. Well, there's an enormous number of opinions that you could have, but there's also an enormous number of rules. And again, the number of rules that you have has to be very, very, very few. You know, we talked about having before the problems with indicators. If you had just 5 indicators on your chart, you'd have 325 different permutations that you could order the relevance of those indicators in. I could have moving average as my primary indicator and a MACD as a secondary indicator and an ATR as my third. Oh, well, let's make the ATR the primary indicator. Let's not worry about moving averages and have a MACD. Those are 2 permutations of 5 potential indicators that you could have. There's 325 of those. So, because there are an infinite number of rules, there are an infinite number of ways that you can order those rules. So you really have to have, you can't just say, well, I'm not going to have an opinion any more so than you can say, well, I'm going to have a bunch of rules. The rules have to be simple. And look, just from your life experience, simple things are simply described. You know, that's why, well, if you're in a job interview, you know, somebody will say, well, in 25 words or less, tell me what your least favorite experience was at your last job and how you dealt with it. Putting a lawnmower assembly together, if we just got it from Lowe's or something, you know, you can have 10,000 sentences in an instruction manual, but what do you go to first? You look at the picture. That's the rule. You know, that's what it's going to look like when it's all done. Now, when you're trading and you have experience in trading, you don't necessarily focus on individual things. It's your cumulative experience of trading or looking at charts and doing the analysis and making decisions and evaluating why they were good decisions at that particular time for that particular set of circumstances you're in, or on the other side, why the decision turned not to be profitable for you. Those years of experience then enable you to simply look at a position and say, man, that ain't going good for me, I'm out. Now, the trick is for an experienced trader to be able to condense all of that experience that allows them to say, well, that doesn't look good and I'm going to get out, from what seems like an opinion to that of a rule. And that's where we get into trouble in reading books and watching videos and things, because folks that really don't know how to teach create a bunch of rules in order to make themselves look like they know what they're doing, because everybody understands a rule. You see a stop sign, it means stop. It doesn't mean, well, if it's Tuesday, stop, but any other day you don't have to stop. Stop is stop. Trading rules aren't quite that simple when applied to the real-time dynamics of trading. You can't simply say that, well, there's an engulfing candle pattern, for example. Well, if you have an engulfing candle pattern and it's showing a positive thing, then it means price is going to go up. Well, all these people that teach engulfing candle pattern trading theory will put their charts up and they'll show you this example candle here, and they'll say, well, look, look what happened after this engulfing candle. The price went up. And if you're not blinded by that particular person's presentation, go to that chart, wherever it is that they're talking about at that time, whatever time frame it is, pull that up on your trading platform and go back, and you'll see that there could have been any number of other engulfing candles that would have satisfied the criteria that this person is talking about, that didn't work out. So you can't assign those types of rules. You can't say preheat oven to 350 and cook until the temperature inside the meat gets to 165. In trading, it's not that simple. You can't have an engulfing candle pattern rule. There has to be more to it than that. And so what happens is that these people that are teaching then go on and say, well, if the MACD is running this and the short moving average is crossed over this one and you get this engulfing candle pattern, you've got confluence among all these indicators which create the rule to enter the trade long. Well, now we're back again at all of these different permutations that you can apply these rules into. How do you go about resolving this in your trading so that your trading isn't trading on opinion, but it's trading based on probabilistic expectation? And you know as well as I do that probabilities are based on the summation of the averages over a large sample set of stuff. And so if you're looking at momentum, for example, just a simple thing as momentum of a candle or a currency price action, you'd have to look at a series of candles in order to see the differential between the momentum in those candles. You'd have to look at the ATR and compare the ATR over the last 14 periods with what the current candle's range is. The ATR could be 10 pips, but the current candle is running 15. Well, is that 15 going in the direction of the trend, or is it going in the opposite direction? What happens if you end up with a pin bar? The rule is, the body of the pin bar has to be like 20%, around 20% of the whole length of the wick. Well, what if it's 22%? What if it's 33%? What if it's 14%? Does that make it even better? You just can't have a rule like that. You can't look at a pin bar and say, oh, I've got this great pin bar and the body is 20% of the whole wick configuration, and so therefore I'm going to price has exhausted itself on the high side and price is going to go down. You can't say that. Well, I've seen pin bars like that in the middle of an uptrend, and this thing just keeps on going. What caused that pin bar? It was a large institutional trader that was going to get in there and run that price up and then pull it back down right away, because there were a whole bunch of orders there, and he's looking for liquidity, and he says, well, look at all these people are following this rising trend, and so if I throw a huge order in there, a pin bar, that's going to convince everybody to go in, and I'll drop that thing down, because it might cost me I don't know, $10 or $20 million to run that thing up and scare all these retail traders, and they'll all jump in. Then I can throw another $10 or $20 million at it to pull the thing back on a sell, and all those folks will get out, and other people whose stops got hit, they'll get out, and everybody will think that the price is turning around, and they'll get in, and I'll just ride that sucker down. That's what happens. So if you don't look at the economics behind what these patterns are doing, all you're doing is forming opinions about what price could, may, should, would do. Well, you can't do that. So My advice for, for today, save your opinions for movie reviews when you're doing Forex trading. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.